So, it hit me a while back during this whole independent movement. You have advisors moving to independence, staying at firms. They really needed a narrative around why they made decisions. Because I had this common question I would ask advisors, because the advisors would hire us typically when they moved to independence because they'd leave behind a lot of resources. They'd hire us to come help them almost from a practice management lens, revamp their whole entire investment process. Because it was kind of like a starting over type mentality. They're like, hey, I need to revamp everything if I'm going to really run this business right. And so we got to asking just questions around their process for asset allocation, security selection, the macro thought processes, everything. And I started coming to the conclusion that a majority of the advisors we work with just didn't have a process or couldn't communicate it effectively. If they couldn't communicate it to me, who was their friend, right? How are they communicating it to clients in a competitive situation where they might be competing with a big name and a big brand? And so what we did was we really just started articulating what we were doing in the form of a framework. Now, that framework started with just two things, and you saw that in Invest to Prosper, the book, which was value and momentum, or value and trend following. We started combining those to help advisors just have a reason for what was going on in portfolios. So if a client's like, hey, why did you sell XYZ company? They would have a message, right, of why they were doing that. And then we added the business cycle and the Fed to that in later times, because it was really important for advisors to be able to articulate what was going on in present day in the business cycle environment. Because of all the large cases I've done where we help advisors win big cases, so 10 million and up opportunities, I would always lead with one question with the client. I would say, do you believe that the business cycle, or that the business cycles, and that the business environment goes up, goes down, there's recessions, there's expansions? And everyone unequivocally would say yes. And getting that agreement off the gate was really important. And then being able to articulate how we made investment decisions based on where we were in a current environment was extremely helpful. And I used to say I could teach an advisor or work with an advisor to win business and really help their investment stuff with just the trend following piece. Now I say that about the business cycle piece because it's so important. So we added that. And so what we have is 4 prongs. Really, it's 3, but I separate out into 4. And we communicate where we are in a given environment through these 3 lenses, if you will. And it's valuation. So where are we? Are we cheaper, expensive? We can do that across countries. We stick pretty broadly in communication with advisors, and then i.e. them with their clients, pretty broad on the valuation bucket. But we talk about valuations, what are expected returns, and then we go to the business cycle and the Fed. And because valuations, as you know, Kevin, they last, it's 7 to 20 years, right? So who's got that time to be wrong if you're on the wrong side of that? So we couple that with what I'd call the business cycle and the Fed. And the reason why is because that's more of like a 2 to 8 year horizon. And so it really matches up or meshes well with a longer term view. And essentially we're just identifying where are we in the business cycle, and is the Fed accommodative or tightening? And then lastly, we look at trends. So the market, that's price action. Market's moving up. Are they strong? Are they moving down and they're weak? And so that works up to about 1 year, right? In terms of academic literature showing you that momentum works over about a 1 year period. And so when we look at those 4 things, right, 3 distinct things, but 4 things on the dashboard, we're able to help an advisor articulate a message to why a portfolio is positioned a certain way, why they might be more offensive and return seeking, or why they may be more risk mitigating. And it just gives them a nice framework for articulating and making those decisions.